Stock market history is paved with high-profile crashes, from the panic of 1907 to the mortgage market collapse of 2008, from the crash of 1929 that sparked the Great Depression to the bursting of the dot-com bubble in March 2000. But one event stands apart, even in this lineup of massive upheavals: the flash crash, or the Black Thursday of May 6, 2010, the day a lone private trader toyed with the global economy to the tune of $1 trillion. This is the story of Navinder Singh Sarao, a trader with Asperger's syndrome. It took investigators more than 5 years to establish his role in the instant 600-point plunge of the Dow Jones Industrial Average using spoofing. Today, Sarao is considered a cult figure in the online trading community. Yet the true reasons that drove him into this global gamble are often overlooked. So, what was the trigger that led this algorithmic trading genius to unleash a storm of the century on the stock market? Sarao was born in London in 1978 to a family of immigrants. The parents of this future market wrecker lived humble lives. His father suffered from a diabetes-related disability, while his mother worked 2 jobs just to make ends meet. Nevertheless, young Navinder, distinguished from childhood by his meticulous nature and extraordinary analytical skills, easily earned an economics degree from Brunel University. Shortly after, Sarao joined the brokerage firm Futex and generated $4 million in profits for the company. In just 6 months, Sarao's mental condition played a significant role in his success. Due to Asperger's syndrome, Navinder struggled with social interactions and displayed a certain childishness. However, when it came to mathematics and computer science, he was head and shoulders above his peers. It is likely he also had savant syndrome, extraordinary giftedness in a specific field, combined with developmental challenges. A good reference point here is Dustin Hoffman's character in Rain Man. However, judging by his actions, Sarao ultimately bore a closer resemblance to Elliot Alderson from the series Amar, Robot. While spending his evenings playing FIFA and sleeping with stuffed animals, Sarao quickly began earning $250,000 a month at Futex. By the time he entered his 30s, he had registered his own firm, Nav Sarao Futures, using the nickname Nav he had acquired in college. As 2008 came to a close, the genius was among the few traders to emerge from the economic crisis with a profit. Yet, like his Japanese counterpart Takashi Kotegawa, Sarao neither liked nor knew how to splash his cash. His most expensive purchase remained a Volkswagen for $5,000, while his daily life consisted of tracksuits and fast food in paper bags. Navinder had encountered spoofing long before Nav Sarao Futures. The intentional manipulation of market prices by placing and then quickly canceling large buy or sell orders was already a well-trodden path. Sarao's ability to analyze massive amounts of exchange data on the fly allowed him to spot foul play instantly. Initially, he actively complained about these spoofers to financial regulators. As his lawyer Roger Burlingame recounted in an interview, Sarao identified fraudulent activities based on the timing, price, and size of orders. Yet not a single one of his complaints was acted upon. This went on for months. Eventually, Sarao, who viewed trading as a game, decided that if you can't beat them, join them, especially since no punishment seemed forthcoming. According to case files, Sarao initially engaged in spoofing manually to demonstrate to an acquaintance how the bots used by high-frequency geeks operated. Later, however, he changed his story, and in January 2018, he even testified against Jitesh Thakur, an associate from Chicago who allegedly helped Navinder write the spoofing software. In 2009, Sarao employed an automated trading program that mimicked orders and used these fake entries to manipulate stock prices. The software targeted futures contracts equal to 1/10 of the standard S&P 500 contract, an index comprising about 500 of the largest publicly traded companies in this. Trades were executed in milliseconds to outpace the reaction of other algorithms to market interference, allowing Navinder to profit in near real time. On May 6, 2010, one of Navinder's sell orders simply crashed the market. On that day, 19,000 orders totaling $200 million to 29% of all orders at that time betting on the index's imminent fall were placed and instantly canceled. According to Nanix, an organization that analyzes streaming exchange data, this caused trading algorithms to become confused on Black Thursday. This opened up an illusory opportunity for arbitrage trading, which led to a plunge in prices for the majority of US securities and indices. The media sphere was seething that day. There was a palpable fear of a Greek default, and everyone was worried about fresh statistics regarding problems in the US labor market. According to a number of analysts, this also added fuel to the fire. Naturally, Sarao could not have predicted the effect his schemes would have. But on that day, forever etched in stock trading history, market capitalization fell by nearly $1 trillion in a matter of minutes. As for the man of the hour himself, he enriched himself by a modest $879,000. It took several years to identify and track down the person responsible for the catastrophe. In the meantime, on July 21, 2010, the Dodd-Frank Wall Street Reform and Consumer Protection Act was passed, representing the most significant overhaul of US financial regulations since the Great Depression. It explicitly banned all forms of spoofing. In the years between the flash crash and his arrest in 2015, Sarao managed to both make a fortune and lose it all, his mental condition being the root cause of both. Having earned over $50 million on the stock exchange, about $12.8 million of which came from spoofing, Navinder, trusting as a child, lost nearly all his earnings by investing in schemes run by various fraudsters and delusional dreamers. The first $33 million vanished in a Ponzi scheme disguised as the commodity holding company, X Asset Management. Sarao fell for the smooth talk of the owner, Jesus Alejandro Garcia Alvarez, who promised an 11% quarterly return. The next $15 million were invested in wind turbines in Scotland, to be built by innovators at Cranwood Holdings. The turbines were never built, and instead of a $520 million profit, investors received news reports about yet another founder fleeing with the money. Navinder blew his last $3 million on the betting firm Iconic, which promised a 20-fold return on investment. However, the firm's bankruptcy dashed the flash crash culprit's last hope of recovering his squandered capital. By that time, the 37-year-old Sarao continued to hide from the world in his parents' home. He could still virtuously visualize vast amounts of market data in his head, but his utter defenselessness against social engineering had clearly broken him, killing his desire to seek quick ways to make money. Information regarding exactly how Sarao was identified as the mastermind behind Black Thursday is contradictory. It is known that the software he used at Nav Sarao Futures raised red flags at the Siem Group exchange as early as 2009, and after some time, an FBI informant working at that exchange got on Navinder's trail. However, the trader's arrest by British police didn't happen until April 2015. Nearly another year passed before Sarao was extradited to this, part of which the unwitting king of spoofing spent in prison. When the case files began to be released, many suspected that investigators simply decided to appoint a scapegoat, as one person could not realistically bear sole responsibility for a catastrophe on the scale of the flash crash. Many experts noted that on that ill-fated Thursday, May 6, 2010, a number of organizations such as the Fund Waddell and Reed Financial rushed to sell tens of thousands of futures contracts totaling billions of dollars, which inevitably contributed to the market turbulence. However, Aidan Goldman, director of the U.S. Commodity Futures Trading Commission, was adamant. It was Sarao who pushed the first domino, fully aware that he was creating an imbalance in orders for personal enrichment. Given the consequences for the global economy, prosecutors initially planned to seek a 380-year prison sentence. However, as proceedings continued, this term began to drop first to 30 years, and then to 8. It ended with Sarao cutting a plea deal in 2016. He was released on bail, pledging to return the $12.9 million the prosecution deemed ill-gotten gains. By that time, Navinder had only $6.9 million left, following a lifetime ban from trading. The former millionaire and menace of Wall Street returned to living on benefits and his parents' pension. However, he hardly noticed the difference, as he had remained an ascetic in both wealth and poverty. His cooperation with investigators and intelligence services in catching other stock market fraudsters also contributed to the outcome. Ultimately, a Chicago court sentenced Sarao, whose sleep problems had begun to worsen, to 1 year of house arrest. The history of the flash crash is full of dark spots. There are even conspiracy theories suggesting that intelligence agencies were aware of Sarao's activities on the eve of the disaster, but did nothing. There is also a growing sentiment that the autistic trader was not a criminal, but a hero, because his spoofing algorithms were pitted against classic high-frequency trading HFT companies that deprive regular investors of profit by front-running their orders. Whatever the case, after Black Thursday 2010, the stock market changed forever. Whether for better or worse, only history can judge, and one can only be happy for Navinder Sarao. for whom the story ended with a return to new games from Canada, rather than life behind bars.